Here we are at number 5, and number 5 is looking at T accounts and closing entries. So what we have is dividends of $11,000, the service revenue of $25,200, and then some expense accounts. We're going to close all of these so that everything ends up in retained earnings, and all of these accounts have a zero balance. That's our goal. So dividends, how do I empty that out? Well, I've got to credit it, correct? And that gets closed directly into retained earnings. And what that does is it makes me annoyed. There. We're going to close that, and that will subtract from retained earnings overall, because we're dispersing some of the net income that we've received this year back to our stockholders. That's not supposed to be there. Let's make that go away, because yours doesn't have that yet. There you go. Okay, now this is empty, but we're soon going to fill it up. Now we look at our service revenue, and we need to close that. We need to obviously debit it, right? We debit it, it closes into the income summary. Now, here's a key. If we have a credit balance when we're all done, we have a net income. If we have a debit balance when we're all done, we have a net loss. So right now, I'm showing a credit balance in the income summary. This is 0. This is 0, which is what we want. We have salaries expense. We've got to close that. We're going to have to credit it. And that gets put right into the income summary. It's going to go against the revenue. Kind of looks like an income statement, doesn't it? Again, this one's 0. We're going to have to close out the rent expense. Is this kind of making sense? 3 different ways of doing it, it seems like, isn't it? So, I don't know where that went. It went to the wrong place. It's annoying. So, $3,000 goes there. That's 0. That's detracting from here. And now we have this one for $2,200. And that's going to go right there too. Hold on. $2,200. So, now what's the difference? This nets up to, oh gosh, what is it? A total of $12,700. So this balance is $12,700. And this balance, if I net those two, then this actually has a credit balance of $12,500, which we want this to be 0. So this netted, okay, or not netted, but this accumulated to $12,700. When that is subtracted from the $25,200, we have a credit balance of $12,500. That has to be closed over here. So I'm going to debit this for $12,500. That should now equal $25,200. We're going to bring that over, and we're going to close right here at $12,500. So now when we take the dividends and subtract that, and then add this, we should have a balance in retained earnings of $21,800. Does that make sense there? Clear as mud, right? That's how it's done. Okay, so this is a permanent account. These are all temporary accounts. Temporary accounts get closed out each period, so that you can start a new period, a new fiscal, or a new accounting period over again. It's very important that you close it out. And then it asks you to calculate the retained earnings balance, and you have it right here. I want you just to do a manual calculation of it. If we look down at number 6, and number 6 is the actual entries, and it's asking you to do the closing entries using the information they've given you. And you'll notice they've got a bunch of different accounts in there that you really don't need. You're only going to close the service revenue into the income summary, and then you're going to close the marketing expenses and the depreciation expenses into the inventory income summary. And that's a fairly simple, it's just a plug and chug in many cases. I would draw some T accounts out so you can see how this interplay, what the interplay is. What are you looking at when you look at that? You're actually looking at the income statement. You've got $4,200 minus the marketing expenses and the depreciation expenses. Those are the numbers you're using, and you're closing that into the income summary. So if we look at number 8, they're getting a little more complicated, aren't they? And number 8, did we miss 7? Oh, 7 you don't do. It's a gift. If you look at number 8, number 8 is a, let me read it for you. Number 8 is closing the accounts for Watts Electric Company, and it wants you to prepare a post-closing balance, and they've already closed everything, and they're just asking you now to take the correct debits and credits and line them up so it adds up to $7,300. And you should have been working with these accounts long enough that they should make sense. There's only one tricky one here, okay? You've got equipment that is a debit balance or a positive balance, but you have accumulated depreciation now. That's a contra account that decreases equipment to get its book value. So this looks like a fairly straightforward activity of looking at the accounts and putting them where they belong. You do a post-closing trial balance just to make sure everything is in balance before you start off the next accounting period. Now, 9. What are we doing with 9? You need to identify the assets, including contra assets and liabilities, and classify each as current or long-term. Current assets are within a year. Long-term assets are anything over a year. The same thing with liabilities. An example of a current asset would be cash, accounts receivable, things that have a relatively short-term life, in essence, that they're current within the year. A long-term asset would be equipment, something that's going to be on the books for several accounting periods. Liabilities, accounts payable, that's constantly turning over, so it turns over at least 3 or 4 times a year. Same thing with your accounts receivable on the asset side, whereas if you had a note payable on there, it's probably going to be over a year before it's terminated or paid off. So that one's a kind of a fun one. And then on 10, they want you to examine the information in 9 and tell what the current assets are, the current liabilities are. Give a total. They want you to give it a total. And then we're going to do a current ratio. And a current ratio is nothing but finding totals and then dividing. And they're very handy. Let's see, what number is it? Number 11. It gives you the accounts, and it has you compute their current ratio and debt ratio. And we've given you what you need to add up here to come up with the amounts that you need to be working with. So if you have problems with that, or you have want to know how close you are, or if you're off, message me, and I'll be glad to give you a check figure on that. Okay? And what's the next one here? Oh, 12. I think we'll do that on another video. So let's get this one wrapped up. We'll stop at 11, and then I'll open up another video for the last one.